Can you feel it? That uneasy stillness. That isn't calm, it's pressure. Silver isn't resting at $65. It's coiled there. And when this week ends, the market won't exhale gently. It will snap. What you are witnessing right now is not inactivity. It only looks that way if you don't understand markets. At this very moment, silver is hovering near the mid-60 range, refusing to either collapse or surge. To a casual observer, this feels dull. The chart barely moves. The candles look small. People assume the story is over. But for anyone who has spent decades watching price behavior, this kind of silence is the loudest signal there is. It is the sound of tension reaching its limit. Markets do not pause without reason. When price stops moving after a sharp advance, it means opposing forces are pressing equally hard. Buyers are stepping in just as quickly as sellers are trying to push price lower. That balance does not last forever. It never does. It resolves violently, one way or the other. And as this week draws to a close, we are approaching the moment where that resolution becomes unavoidable. Over the last several days, institutional players have thrown everything they have at this market. Margin requirements were raised. Paper contracts were dumped. Every familiar suppression tactic was deployed with the goal of forcing silver back down into the low 60s. The intent was clear: damage the chart, scare momentum traders, and create the illusion that the breakout had failed. Yet despite all of that pressure, the price remains elevated. It refuses to give ground. That refusal matters more than any headline. In fact, the market's unwillingness to fall is one of the most bullish signals imaginable. When an asset absorbs sustained selling pressure without breaking, it tells you something fundamental has changed beneath the surface. The usual levers are no longer working. The structure is stronger than expected. And that is exactly what is happening here. This particular weekly close carries far more weight than most people realize. In institutional finance, daily price movement is largely irrelevant. Intraday swings are noise. What truly matters is where price settles at the end of the week. That closing level determines how charts are interpreted, how models are adjusted, and how capital is allocated. The weekly close is the final verdict on who controlled the market. For years, silver breakouts were routinely neutralized late on Fridays. Large sell orders would appear in the final hours of trading, knocking price down just enough to distort the weekly candle. Instead of a clean breakout, traders were left with long upper wicks, visual evidence of rejection. Those ugly candles discouraged trend followers and validated bearish narratives. It was a repeatable strategy, and it worked for a long time. This week is different. Silver is not closing weak. It is holding near the highs. If this level remains intact into the bell, the weekly chart will print a strong, decisive candle that signals dominance from buyers throughout the entire week. Technicians refer to this as a candle with minimal or no wick, indicating sustained control. That kind of structure is not ignored by machines. Modern markets are not driven primarily by humans. The majority of volume now flows through automated systems, trend-following algorithms that manage enormous pools of capital. These systems do not think, speculate, or debate. They execute rules. One of the most important of those rules is simple: when price closes above a well-defined resistance level on a weekly basis, the system switches from neutral to long. That resistance level has been sitting around $65. We are above it. If the market holds here through the close, those systems recalibrate over the weekend. Position sizes are calculated, risk parameters are adjusted, and when the next session opens, buy orders are triggered automatically. This is not discretionary buying. It is mechanical. It is relentless. And it is exactly what the banks are trying to avoid. This explains the strange calm you see on the chart. It is not peace, it is standoff. Everyone knows what is at stake. If price breaks down, the breakout narrative collapses. If it holds, a cascade of automated demand is unleashed. The market is holding its breath because it is standing at the edge of that decision. To understand why this consolidation is constructive rather than bearish, you need to look at how price arrived here. Silver did not grind its way slowly from 60 to 65. It surged. That kind of vertical move cannot continue indefinitely. Markets require pauses to digest gains. Without consolidation, rallies burn out. With it, they reset and continue. Instead of collapsing back toward its starting point, silver simply stopped and moved sideways. It began trading in a narrow range, with every attempt to push lower being met by immediate buying. In technical terms, this is a continuation pattern. It reflects profit, taking that as being absorbed by fresh demand. Sellers exit, buyers enter, and price remains stable. This absorption process is critical. It shows that the market is not running out of buyers. On the contrary, demand is strong enough to prevent retracement. Pressure builds quietly during these phases. Like compressing a spring, the longer the range holds, the more force is stored. When that compression ends, the release is abrupt. There is also a psychological dimension to this price level that cannot be ignored. For years, $65 was treated as an unattainable fantasy. Investors talked about it as a distant target, a level at which everyone would rush to sell. Now that we are here, that mass liquidation has not occurred. Some short-term traders have taken profits, but the broader market is holding firm. This shift in behavior is significant. It suggests that participants no longer view this price as an endpoint. They see it as a waypoint. Inflation, debt expansion, industrial demand, and currency debasement have reframed expectations. What once looked expensive now looks justified, even cheap. That change in perception is how long-term trends accelerate. High prices are supposed to suppress demand. In this case, they are doing the opposite. Higher prices are validating the thesis and attracting new interest. That is the hallmark of a structural bull market. When rising prices generate more demand instead of less, the feedback loop becomes self-reinforcing. Another important detail is what did not happen this week. Traditionally, Fridays, especially those coinciding with economic data releases, have been prime opportunities for engineered sell-offs. Strength in the dollar, weak employment numbers, or vague macro headlines have often been used as excuses to knock metals lower. This time, those tactics failed. Attempts to force a decline were met with immediate buying. The reason is simple: the physical market is tight. Inventories are constrained. Refining capacity is strained. Industrial users cannot afford to wait. When paper prices dip, real demand appears. Discounts are treated as opportunities, not warnings. This dynamic places a floor under price that is difficult to break. As a result, manipulation has shifted from suppression to delay. The market can be stalled, but it cannot be pushed meaningfully lower without worsening underlying shortages. That creates a situation where sideways movement becomes the path of least resistance for those trying to maintain control. But sideways is not bearish when it follows a sharp advance. It is preparation. Once the market closes for the week, attention shifts to what happens next. Over the weekend, automated systems process the data. They do not sleep. They do not second guess. If the criteria are met, they prepare orders. By the time the next session opens, those decisions are already made. This is why holding cash into such a close carries risk. Markets do not freeze when exchanges shut their doors. Information continues to flow. Policy decisions, geopolitical developments, supply disruptions, none of these respect trading hours. When news breaks while markets are closed, price adjusts instantly upon reopening. Often that adjustment is a gap. In an environment like this, the greater danger is not owning metal, it is being forced to re-enter at higher prices after the fact. Cash loses purchasing power when prices reprice upward overnight. That risk is increasingly visible to market participants, which is why selling pressure has been muted into the close. Media behavior is also beginning to change. For years, silver was ignored or ridiculed. Now it is being discussed. Articles highlight its performance. Segments mention supply constraints. Comparisons are drawn to strategic materials. This shift matters because mainstream attention legitimizes the trade for a broader audience. Most investors do not study charts or mine data. They follow narratives. When the narrative turns, capital follows. Financial advisors become comfortable recommending exposure. Institutions reconsider allocations. The general public enters late, but when it enters, it does so at scale. That phase is where trends often become explosive. Options markets are reinforcing this pressure. As price holds above key strike levels, call options move in the money. That creates obligations for market makers who must hedge exposure by buying the underlying asset. When this occurs near expiration, it can force additional buying at precisely the moment liquidity is thinning. The result is a setup where multiple forces align. Algorithms are primed. Physical demand is firm. Psychological resistance has been broken. Media validation is increasing. Derivatives positioning is shifting. None of these elements alone guarantees continuation, but together they create powerful momentum. To understand where this could lead, it helps to step back and look at longer-term structures. Markets leave patterns behind them, shapes that reflect collective behavior over decades. On very long time frames, silver has been forming one of the most well-known continuation patterns in technical analysis. When you examine the monthly chart stretching back several decades, you see two prominent peaks separated by a long basing period. Between those peaks, price traced a rounded bottom that took years to form. After the second peak, the market drifted lower and sideways again, forming what technicians call a handle. That handle represents consolidation, frustration, and attrition. Breakouts from patterns of that magnitude do not resolve quietly. The longer the formation, the larger the implied move. The mathematics of such structures project targets that feel extreme when viewed from the present, but they are derived from historical price behavior, not speculation. Intermediate tools support this perspective. Extension levels derived from proportional relationships often act as magnets once price clears major resistance. The next such level sits well above the current range. Between here and there, historical trading activity is sparse, meaning there is little overhead supply to slow progress. Momentum indicators also tell an important story. While short-term measures show elevated readings, longer-term metrics remain far from extremes seen at previous cycle peaks. In strong trends, momentum stays high for extended periods. What looks overextended to inexperienced traders is often just the beginning of acceleration. Human psychology tends to misinterpret strength as danger. In reality, strength is confirmation. Weakness is what kills trends. Right now, weakness is absent. Every dip is being bought. Every attempt to force price lower is absorbed. That persistence is the signature of a market being repriced, not traded. Round numbers will continue to attract attention. They always do. They act as psychological checkpoints where participants pause, reassess, and often attempt to act preemptively. In shortage environments, those pauses tend to be brief. Sellers appear, buyers overwhelm them, and price moves on. Trying to time exits around such levels is risky. In fast-moving markets, gaps can erase opportunities to re-enter. Selling in anticipation of a pullback that never comes is one of the most common ways investors lose exposure during major trends. As the week ends, the most difficult challenge is not analysis, it is discipline. Holding a winning position through uncertainty is emotionally taxing. The urge to act, to lock in gains, to do something, intensifies when markets close and headlines continue. Resisting that urge is where most of the reward lies. There's a reason veteran traders emphasize patience over cleverness. Trends do not end because they are overbought. They end when demand is exhausted or supply overwhelms it. Neither condition is present here. The structure remains intact. The drivers remain active. Over the next 48 hours, news will circulate. Opinions will clash. Fear and optimism will both compete for attention. None of that changes the chart that just printed. None of it alters the fact that key levels held under pressure. When markets reopen, price will respond not to weekend commentary, but to the positioning decisions already made. If gaps appear, they will reflect imbalance, not randomness. Whether that gap is higher or lower, the broader context matters more than the first tick. The larger lesson in moments like this is conviction grounded in evidence. For years, silver investors operated on hope. They waited for conditions to align. This week, alignment was visible. Resistance failed. Suppression faltered. Structure held. Hope has been replaced by confirmation. That shift is subtle but powerful. It changes how volatility is interpreted. Pullbacks become opportunities instead of threats. Rallies become validation instead of temptation. As the bell rings and the week closes, one thing is clear. This market did not break when it was supposed to. That alone speaks volumes. Whatever happens next, the character of price has changed, and markets rarely revert to old behavior once that change is established. Enjoy the pause. The quiet will not last.